Good afternoon, everybody. I hope everybody enjoyed listening to Sandy. I absolutely love listening to an economist talk who knows what he's doing for a change. And he dumbs it down enough so that I can actually understand what's going on. So this afternoon, we thought we'd try to do at least as well as we did last year with a Shark Tank presentation. This year, it's called Shark Tank 2, the Recapitalization. So before I introduce our esteemed guests here, and I'm sure you'll recognize at least one from last year, I'd like to tell you a little bit about the company. Now, in your handout you got today, and once again, this shows how we actually listen to what you write on the surveys. Last year, we only put a summary in there of the company that we were selling. This year, we put the entire offering memorandum that was sent to these 4 private equity groups to make a bid for this company. So you can read it at your leisure, take it with you, do as you wish. The information is all the information they were given, so they basically had to make these bids based on the information that was in that book. So you are seeing the same thing they are. So we have a company today. Our company is called Advanced Medical. You are 100% owner of Advanced Medical. You are 55 years old and wish to team up with an equity group to recapitalize the company. Advanced Medical is an ISO 9001 certified manufacturer of specialty orthopedic implants and instrumentation. The company is a recognized leader of surgical solutions for the foot and ankle market. It's located in Waukesha, Wisconsin. Let's take a look at what your company looks like. As we mentioned, you do surgical solutions for the foot and ankle market. As you can see from the financial results, it's an investment banker's dream. I think everybody in the audience who's a deal maker would love to bring this company out. The company grew from $27 million in sales in 2011 to a projected $44 million in 2014. EBITDA 3.5 up to $6.4 million by the time we got to 2014. Customers. If any of you were here last year, we threw a little twist at everybody and gave a little customer concentration, threw a few industries in there that somebody didn't like who will remain nameless. But this year we decided that we're going to make it a little difficult for somebody to pick on our customer concentration. So we basically said, hey, biggest customers 2%, top 10 customers are not even 15% of the company sales. So a nice bit of diversification. We'll see how the private equity groups handle this one. So we put a nice group of people together, 4 private equity panelists. Remember last year when we did this thing, we did an entire sale. This is going to be a recap, and you didn't know this, but I knew this. We started with the low and went to the highest, so you're probably looking at it going, oh, poor Gretchen. She's going to start off and she's going to be the low bidder again. She's cheap, yeah, just what you want everybody in the audience to know, right, exactly. But the reality is this is a recap, and there is no right answer or wrong answer. It really depends on what you want to do with your company, whether you want to take more off the table or less off the table. And I think after you hear them walk through their bids, you're going to be confused to a degree. And at the same time, you're going to look at this and think, well, what works for me? And look at the different solutions. So what I'd like to do is just take a second to introduce our esteemed guest. Once again, returning for an encore performance because she did such a fabulous time last time. Gretchen Perkins from Huron Capital, located over in Detroit, Michigan. Sitting to her immediate side is Matt Lane from GenCap America. And he joins us. He flew all the way up here from Tennessee to join us for this event, so we thank him for that. Next is Tom Campion from Merit Capital down in Chicago. And next to him is Chip Grace from May River Capital, also from Illinois. Now, the rules that we put together on this one is, once again, you cannot, they had to write an offer for this business. Like last time, you'll notice that the offers were, some were low and some were high. The low ones, of course, were people who weren't interested in buying the company, but they did me a favor by at least writing an offer to indicate that. All private equity groups had to write an offer for this thing. These offers were anywhere from 4 to 11 pages long. So each one of these individuals had to do a lot of homework, and I can't thank them enough for doing that. It wasn't an easy task. You should have seen the phone calls I got once I sent them the packet of information they had to do. They said, well, wait a minute, this is a lot of work for us to do, but I appreciate everything they did. Plus, I'd like to also thank Gretchen. As you notice, there's a sign on every one of our tables. Huron Capital is our lunch sponsor today. They were nice enough to help us out with that, and MBBI is proud to have them as a lunchtime sponsor. So now that we've introduced the panel, there's going to be in the back of the book, there's a survey. And that survey has who you would like to team up with as a private equity group. It's going to be a little difficult, and I'm hoping you'll ask some good questions when we're done. But we'd also like to see who the audience would think would be good to have on their team. This is the chart we put up last time, and we will fill it in each time with, I just love when the private equity group on the panel turns around to see, they were all looking to see what the numbers were right away, because they're all interested to see what the other groups are bidding, because nobody knows. This is all very confidential. Once everybody talks, we will put the summary information up for everybody. For those of you who want to take this information again with you, Mary in the back has a huge stack of the summary sheets. Nobody gets it until we're over. Got it? So all the information will be up here for questions, and then when you leave, Mary will be able to hand out the summary sheets so that you can take all the information with you, so you can compare it with the offering memorandum that you have in front of you. With that, I'm going to hand it off to the lovely Gretchen Perkins.
Terrific. Thank you, Tom. Thanks for inviting me back. And this is an awesome event, and that's why I wanted to sponsor the lunch when I was here last year for the first time and saw how many folks are here. So thanks for coming. This is a really nice company. This is one of those fun companies where you basically, I had to have the American Orthopedic Foot and Ankle Society glossary of terms up on my computer while I was reading it, because, I don't know about you, but as you read through the information, I'll give you a couple of cliff notes here. A metatarsal phalangeal joint is basically just the spot where your toe connects with your foot. An osteotomy is a cut that a surgeon makes, a cut. And I was trying to research their claim about their effectiveness on calcaneal cubitoid, talonavicular, and midfoot arthrodosis. I forgot for a moment from college science class what arthrodosis is, so I looked that up, and that's also known as, of course, ankyliosis or syndesis, which is the artificial induction of joint ossification. So, for any of you, I totally forgot that. Now I remember when I looked it up, it reminded me, so any of you that are ossified challenged, you might be a candidate for that. So, that said, this is a really nice company. I think, do you want us to go through just the terms and then we'll talk about why we like
Sure.
and didn't like after?
Whatever works for you, because
Okay.
remember, these are your buyers.
All right.
So pitch
All
to
right.
them.
So, Mr. Bauer and family, I would like to pay $48 million for your business, which is 7.5 times the expected 2014 EBITDA. I'd like to see a $4 million rollover investment from Jim Bauer, the CEO, which is actually less than 10%. And I am hoping that, so all we would require is a $4 million rollover reinvestment. But what I would hope is that after he and the rest of the team have done their due diligence on Huron Capital and see kind of our track record and how we've produced gains for recapitalizations in our past, and actually, just a moment, is there anyone from the press here? I literally have to always ask that now. My chief compliance officer, since we're now registered with the SEC, requires that I ask that before I'm speaking before a group, so everybody can tell him I did do that, and nobody raised their hand. So I'm going to hope that after the Bauer family and the other management members that we're going to offer equity to do some due diligence on us, they'll say, hey, we want to roll over more. I think that's what we're hoping, but we're only going to require $10 million. We're going to invite Eric Smith, the Chief Operating Officer, and the VP of Engineering to make an investment meaningful to their personal net worth. And, in most of the businesses that we're all investing in, these guys haven't had wealth creation events. And, depending upon whether their kids are in college at the time or not, or, whatever, they may not have a lot of liquid cash. And so we will create a loan matching program to absolutely double whatever they can invest. So if all they have is $25,000 to invest, we will create a loan and match that $25,000 so they have a $50,000 equity investment. If they have $100,000 to invest, we will match that as well. We want them to be meaningfully, we want this, 5-7 years down the road when we exit the investment, we want it to be a major wealth creation event in their lives. And so we want everybody rowing in the same direction. And all the investments by the other management members would be in the same security as Huron Capital's equity. So again, interests are aligned. the structure of our recap, we're going to put in half of the purchase price, so fully $24 million in equity. That's what we've been doing late. Thank you. that was blinding us up here. That's what we've been doing over the past couple of years. I think over time our average is in 40% anyways. We've been over equitizing things. It doesn't move the needle that much on equity returns, and we just like having a less levered structure. And most of the business owners of companies like this that we're investing in their businesses, they've never operated with a lot of debt, and so less debt is more comfortable to them. And so we'll need $24 million of bank debt, which is only 3.75 times. This deal in the current debt markets will command a lot more. You could probably easily get 4.5 times. I'd say over 5 if it were a little more than $6 million in EBITDA, but maybe even in $6 million of EBITDA, you could get over 5 times. It's kind of crazy. We don't want to take that much. We're only going to take 3.75. Terms of the purchase price, cash only, 100% cash. There's going to be no earnouts or no seller notes from us. We find those to be an invitation for a big argument and a strange disalignment of interests down the road when those are measured and paid out. So we're not going to do that. It's all cash, and we would require Jim Bauer to sign a non-compete for us. Incentives for the rest of the management team. I had mentioned that we're going to establish a 12% equity pool for the management team. We're going to run through at least the top 3 guys. So CEO, COO, VP of engineering. And then below that, we'll talk with Jim Bauer and let Jim tell us if there are others further down. They have a VP of sales. They have an FDA compliance person. They have a controller. Another kind of unique thing, this company has a CFO and a controller, which is, actually, did it have CFO? A COO, right.
But with accounting background.
Right, with a very strong accounting background. Thank you very much.
You can tell they read this.
Very strong accounting
I
background.
lost her a bit, so I can help.
So and that's a very common discussion we have all the time with the owner, the seller. Who in your management team deserves to have an equity stake in this business, and let's make that happen here at this opportunity. Because usually they don't have equity going in. Probably not telling you guys anything you don't know. Expected timing, 60 days. This isn't a massively complicated business with multiple locations and lots to perform due diligence on, other than a couple of areas I'll hit later, but we think we can get this thing done and closed in 60 days. Working capital adjustments, the standard, the purchase price is going to be adjusted up or down based upon the working capital level that is delivered at closing versus what the target was, which is going to be set at average net working capital for the 12 months prior to closing. There will always be arguments about that. I don't understand why that's always so difficult. Escrow amount to cover reps and warranties and baskets and caps for indemnification. We are doing this very routinely now. There will be no escrow. There will be no indemnification baskets and caps. We're going to buy a policy for rep and warranty insurance to eliminate the seller's risk in that regard. And it's been a really effective and compelling attribute to our proposals. However, I will say more and more people are doing it. It's becoming less and less of a differentiator. But it's a pretty sweet way to, it will cost Huron somewhere between, probably cost $200,000 and $250,000 to buy this policy, and then the deductible is somewhere between $500,000 and $1 million. So, we're out at worst, between $1.25 million and $750,000, and we of course bake that into our valuation. But it takes that big risk and that huge discussion, that fear from the seller completely off the table. We just say, let's just put that to the side. So that's what we're going to do. All right, so those are the terms of my offer. Do you want me to stop and then talk about the qualitative after, or?
No, go ahead.
Okay.
Yeah. because you got your audience pinned.
All right,
I mean,
very
there's
good.
checkbooks
All right.
out. I mean, let's go.
Two really important due diligence points for us in this deal. First of all, we love your industry, Mr. Bauer. This is a great industry, very steady and growing over the long term. We expect with the aging of America and the increased activity levels, I mean, I think all of us who are 50 and over are doing a lot more things than our parents ever did, and we're getting hurt, and so we're being injured, and we're wearing out, and so I think this foot and ankle, we really like this space for that reason. But there's two very important areas that we would need to, that will be part of our due diligence: litigation experience with your business, Advanced Medical, and all the others in your space. Is this a sector that is rife with litigation regarding these implants, not working or failing or whatever? And reimbursement. In the materials, we really were provided no information on who is the ultimate payer here. I know the customers are the orthopedic surgeons, hospitals even, but is it paid by, are these things covered by insurance? Is the payer base heavily Medicare, Medicaid, in which case my 7.5 valuation will decline. So the assessment of the payer mix is a huge item that's open here. But presuming we got comfortable with that and it was, insurance covered rather than government reimbursement, the 7.5 stands. And the due diligence on the management team is really critical. On paper and in person, Mr. Bauer, you seem awesome. I like the fact that you started out as a tool maker and clearly have an intellectual curiosity about how things work, and you've created this really successful company on your ability to make stuff, and you've picked a sector that's really hot and lucrative. We like all that. Your COO has a solid accounting background. Again, thanks, Tom.
I'm good at the competition.
Your chief of engineering appears very, very solid as well. Really good credentials. Manages a team of 5 engineers. What I don't see in there is if these engineers are all degreed engineers or not. That's a very important question for us in kind of assessing any deal where engineering is important. Are they degreed engineers, or there are guys working in engineering who are just good at it but aren't degreed? We like to see them degreed. And so those are really important things that will be on the punch list for due diligence. Again, really great situation. It's the original entrepreneur who wants to stick around. Minimal customer concentration. It's a beautiful thing. I love the very creative bonus plan they have for the employees, which they pay employees quarterly based upon the company's achievement of certain goals, and it's meaningful dollars from somebody at the low level to somebody who's the VP of engineering. So I think it's great. It's located in Waukesha, Wisconsin, a very solid area to find great employees. Right, you have tons of higher education in this area, as well as good public schools, solid work ethic, Midwestern work ethic. I love that. Who doesn't love that? Consistent EBITDA and better than decent margins. 15% EBITDA is good. Again, some of the things I don't like about the company, or possibly don't like, is just that this industry has significant litigation history for product defects. I don't know about foot and ankle in particular, but just this industry of implants do. And you're competing against some really deep-pocketed businesses, Zimmer, Biomet, Johnson & Johnson, who have billions of dollars to spend on R&D. You have $44 million in revenues. You have a great history of developing new products and staying ahead of the game, and surgeons want to buy your products, but can you continue that? Have you been lucky? What is the R&D system that you have in place? How robust is it? We'd want to look at the forward sales revenue projections. How many of projected revenues are coming from new products this year? Is it 10%? Is it consistently 10%, or is it 30%? Have you had a couple of big hits that have, on a product basis? Is there product concentration, or is it a nice diversity of many different things that you're constantly either coming up with something new or improving? So that's the fact that these types of businesses are driven by R&D is a big point of due diligence as well. Capacity, it says in there, can the output really be doubled at their current facility with no investment? We've heard that before. It rarely works out like that. So, but we'd have to look at that. There's also some really great tax credits this business gets, which is great. However, you know, what is the outlook for these types of tax credits being continued internationally and domestically? And, you know, it's not a huge number in here, but, you know, multiply it by 7.5 and it starts being real money in our valuation. So we're going to want to assess that. And I think I will stop for now.
Fantastic.
Love it.
With that, let's see if I can get this to show. There we go. So I'm just going to take 2 seconds before I turn it over to Matt. So Matt, just take a breather for a second and co-pose. So that everybody can evaluate these, we put a couple things up here that we thought were important. First of all, the valuation, the company ownership split, which is everybody is important, and then what I call the takeaways, because at the end of the day, you want to know what you're walking away with this offer, with this deal. In other words, what percentage of the company you're keeping and how much cash you get. The structures, which is important because you need to know what the rollover equity is, what they're putting in equity, and how much debt they're putting on the books, and the caps and baskets, which she mentions, and the incentive. Did you talk about the incentive at all, or did you kind of slide over
Yeah,
that?
I said we have a 12% instead of equity pool, and we'd go through the top 3 employees, and then you, Mr. Bauer, will help us decide how much further down we're going to
Gotcha.
go in the company.
All right, so there you go.
So Tom got those numbers right. Good job.
Thank you. Man, it's all yours.
Thanks for having me. I'm happy to be here. And if this were real, this is the point where I would check my iPad to see if the Bucks were in town, since our offer likely wouldn't win. But I do realize, this being my first year, I now realize it's okay to overpay in this in this example.
The best part is I know he doesn't know. This is really getting to be good.
No, but I think we do have a compelling offer. It's the structure is different. We value the company at $37 million, which is about 5.9 times 2014 numbers and about 7 times 2013. One of the things that we've done that's unique is we've offered the management team an opportunity to own 40% of the company going forward. So we'll have a controlling position, but management will have significant ownership, and that's primarily through Mr. Bauer's rollover. We'd have him roll in excess of $6 million. Collectively, the management team would invest $6.8 million, and we also put in place a structure where we will lend money to management where they need it. So we recognize that if you're below the founder family-owned level, that you don't have significant amounts of capital. So in those deals where they don't, but they want ownership, we work out a scenario where we'll loan them the money, and we put in place incentive-based bonus plans where they can generally use that money to repay the loan. So one of the things we want to do is make sure that if management wants to have an ownership stake, that they can do that. So in all of our deals, we take a control position, but management has ownership, and in most cases it's significant. Our focus at GenCap, we've been around since 1986. We've made 41 investments. We've never lost money on a deal, and we can say that today. I'm going to continue to say it until we can't say it anymore.
Absolutely.
But part of that is our philosophy is very much we're going to empower management, and we want management to have a significant ownership stake, and we're not an operationally focused fund. So our involvement is going to be board level and strategic, and management will continue to run the day-to-day operations with very little involvement from us. Again, our involvement is going to be board level and strategic. So we're not going to come in and have them change things. So oftentimes we find that we are in deals where management's looking to buy it, we're management's choice. We're an advocate for management because our focus is such that we're going to allow them to continue to run the business. So I think that's one of the things that's going to separate us, is they're going to have meaningful ownership, and they're going to get to continue to run the business without much day-to-day tinkering from the private equity group. So just going down the structure, the way we structure this, we've got $15 million of senior debt And then we have a $6 million piece of subordinated debt, which is pretty conservative, as Gretchen was saying, in today's environment. You could probably get more than that, but our approach also is not to over-lever. We want to make sure if we do hit a rough patch that the business can continue to operate. And after that, we have management having contributing $6.8 million for their equity, and then we would put in $10.2 million of our own money. So that's kind of the structure. Again, with that, management would have a 40% ownership. We have $1.85 million as an escrow, so a fairly small escrow. And then on indemnification, basket, and cap, we have a 1% basket and a 10% cap. The way we're looking at working capital is we were also put in place a trailing 12-month average of net working capital kind of as our target. Compare that to the closing. And the industry, we estimate it would take about 90 days to close. We could probably do that quicker, but that's kind of our standard terms is usually a 90-day term. As we look at this business, there are a lot of things that we like about it. This is, as Tom said, this is an investment banker or private equity's dream. I mean, it's a beautiful looking company. You've got improving gross and EBITDA margins, consistent growth since 2011, really deep management team. One of the things that we see a lot in these smaller companies is a lot of these, it's just the founder, and there's not a second level or second tier of management. This one has a pretty deep team that looks good on paper. Again, part of our diligence would be spending a lot of time with management to understand their capabilities, because again, we rely on management to run the company. So a big part of our investment thesis is ensuring that management is capable and solid, and they're able to execute on a growth plan. The other thing that's great is that there's no customer concentration. It's a very diverse customer base. The demographics with the aging population looks great for this industry. Admittedly, we don't do a whole lot in healthcare, but this certainly would fit our model, and it looks like something that, with the aging population and demographics, it looks like there's a lot of opportunity for growth. The memo suggests that there is ability to grow in the existing facility. You can double capacity. Again, we'd have to do some work on that to make sure that's the case. But all in all, very favorable. So some of the things that are a negative or we have to work on is this is a traditional recapitalization, so we need to make sure that we understand the owner's motivation here. I mean, what's the reason? Is this just to get another bite at the apple? Is this diversify to get a liquidity event, or is there something else going on that that you're selling it for different reasons? Reimbursement risk, want to get comfortable that the reimbursement risk is minimal. It's a difficult regulatory environment. We want to get our arms around the regulatory environment. And it's also a highly competitive industry. There are some very large public and well-capitalized competitors, so we need to understand our place in the market. Management's desire to own equity is very important to us. Again, not only understanding their capabilities, but also their desire and willingness to invest in the company. We would also look at results back for 2007, 2008, see how things did in the recession as it continued to grow throughout the period. Understanding the competitive positioning, ability to differentiate pricing, where does it stand there? And product liability is going to be a big area that we need to focus on diligence, because that's obviously very important to this industry. And then the tax shields, I mean, that's a nice advantage. We want to further understand that. And I mentioned this earlier, but just the regulatory environment and how this company fits within the environment. So that's kind of a quick overview of the way we see it. Again, it's a very exciting opportunity, and I think it would be a good fit in our portfolio.
Thank you, Matt. Appreciate that. All right, there's Matt's summary for everybody to see out there, and that covers it. It's a little hard to talk a lot after listening to Gretchen do a wonderful speech on the company, so I always let her go first, because that way you guys can just say ditto and keep it moving along. Tommy, you're up.
Thank you, Tom. I'll go with the deal first, then I'll get to the touchy-feely stuff. Initially, we're looking at a $34.5 million distribution to the current owner for 70% of the business. And that'd be an implied value of $49 million, but I can argue a lot of different ways. With recaps, they're very much, it's a bit of an art and a science. So I think that, I can, based on rollover differently, I can come with different valuations, but basically for 70% of the business, you're gonna get 70% of the business, we're gonna give them $34.5 million. We have funded it relatively conservatively on a senior leverage basis. We have senior of only $9.5 million, which is about 1.5 times, because we're gonna put a big chunk of sub-debt in, because Merit does sub-debt and equity, so we're about 19.2 million of sub-debt, 6.5 million of equity, so you'll have 1.5 turns of senior, about 4.6 turns total debt, and 6.5 million of equity. We're okay with the kind of aggressive overall debt, primarily because we hold the equity, so we don't have many conflicts with ourselves normally, so that's helpful. At least we try not to. And then, but we look at the senior. We always look at businesses can get in trouble when the senior's not comfortable. And if you stretch the senior in a downturn, many people who said they were cash flow lenders, all of a sudden, wait a second. I mean, there's no assets, and they get a little bit nervous. So we rely on the senior. Then hopefully, this has an opportunity to maybe have some tuck-in acquisitions. We'll rely on a senior for that going forward. And then you don't have to recut the equity. You don't have to dip back into your pocket for more equity to maintain your ownership position. So we think that's usually a nice way to structure the business. We're also comfortable. It's a low CapEx business. We expect to deduct goodwill for tax purposes, so that's good for cash flow. So we expect that to get paid down fairly quickly. On our caps and baskets, we're looking at a $4 million cap, which will also equal the escrow. It'll be released, half of it in 12 months, the other half in 18 months, assuming nothing has occurred. Our basket's $80,000. This indemnification doesn't apply to fundamental reps, which is like, hey, I actually own the shares, things like that, things that you expect, fraud, all those type of things. Environmental and tax, we usually say if it's on your, if it's a tax problem on your dime, you pay for it. If it's on us, we'll pay for it. On our incentive equity, we structure, there's no, we expect this guy to want Mr. Bauer to have the second bite at the apple, but we would assume that probably we have a 12% incentive equity. Sounds really familiar.
I like it. I think
which
it's
is, I was
solid.
like, wow. Yeah, I mean, you sure didn't share notes here, Tom. But and we would assume that most of that would go to the team, that below Mr. Bauer, and we'd work with him. And that incentive is going to come out 100% out of Merit. So we will approve that with Mr. Bauer. He's going to walk through who's the key people, and we're going to say we agree because it's coming out of my pocket. But how we set them up it's based on achieving an equity value target at our exit, so we're aligned with interest, and basically it's between $50 and $100 million. You earn it in pro rata, and it's from $1. So we set it up so they'll get capital gains treatment, and you just do that by issuing all the shares day one, all the incentive shares. They really have almost no value, so there's really no tax implication. But then if they hit the targets, they stay outstanding. If they don't hit the targets, the company can buy them back at a nominal value. But what it does for them, it gets them a capital gains treatment, which is huge for the management team, and it goes back to $1. So for example, they hit $100 million of value when we leave, they get $12 million. Okay, so it's pretty straightforward, simple plan. And it's based on your historical growth rate of 15 to 16% and a 7 to 8 times type exit in 5 years. You'd be over $100 million. So you have a good chance that we didn't buy 70%, we actually bought 58% of your business. That's the big part of the deal. Maybe now we'll get to the touchy-feely stuff. Okay. We've been fortunate to do a number of recapitalizations. But we've actually done both minority and majority recaps. So the fact that we're not wed to 70%. If something else makes sense for you, just the math's going to change, but if you want to keep a majority, that's fine. We're not control freaks. We're not looking to run your business very similar to Matt. We expect to put the right people in the right seats, have them manage the business, work on the bigger picture stuff like capital allocation, but not be your day-to-day manager. There is a normal concern, of course, that hey, I'm going to put a lot of money in someone's pocket. They're going to go to the beach, And we've been fortunate and found that people who have created their own business, many times with, risk off the table, they redouble their efforts. I mean, we've had very good partners in Recaps. We've been very fortunate that they've got a lot of pride in what they've built. Many times the name's on their door. They've got employees they're loyal to, customers, suppliers. So we're not as concerned about that risk. You got to make that read. But so far, we've been very fortunate that no one has left the building after we gave them the money. As I said before, recaps are much more of a, it's a bit of an art and a science. Basically, you want to find out what do they want to get? What do you want to get out of this? How much money do you want to get off the table? How much do you want to have as interest going forward? How do you want the managers to participate going forward? So we're very flexible in regards to that structure. In regards to your business, it's a beautiful business, real positive trends with aging population, very strong, consistent growth. Margins are nice, but not overly high. They appear sustainable in the 14 to 15% range. If you have too high margins, I'd be concerned in the regulatory environment, what could potentially happen. There's plenty of capacity to grow, you say, but I mean, a bigger concern, which was talked about earlier, is can you find the people? I mean, in manufacturing business today, we're held back growth by finding skilled labor. And it's amazing. We just don't, how many people flunk the drug tests, et cetera, et cetera. Also, you really don't want an accident in your facility because then they'll start testing everybody and you may lose a big chunk of your workforce. I shouldn't say that, but it's true. And also, oh, by the way, we also are registered. I should have said, are there any press here? But that was already clear. Thank you. We're helping each other out. Thank you. It's, in my mind, a young management team, which, as I get older, that denominator seems to get moving on me. I think it's an extremely young management team. No, it's but a nice team, a good Wisconsin-based team. I'm originally from here. In Wisconsin, it's a very tight network. I could check these guys out very quickly, which is nice. You knew somebody who went to their school and stuff. It's a great place to, references, et cetera. It's a very good place to do business. I love the COO controller combination. I don't think you probably need a CFO with that strong of COO. The fact that you have an FDA coordinator in place already is a positive. I probably would look to see, do you have a compliance person on board? We've done a couple of healthcare deals, and that's just becoming a bigger part, and you can't, if you go sideways, you're in a lot of trouble. I think also I like the fact that this is not a commodity product. If you get into the commodities in healthcare with oxygen and wheelchairs, you get into the bid and the auction business. This is not, I think you'd probably be pretty comfortable maintaining your margins. Then I've got, let's see, just a couple of questions. A big part is I'm curious on how you go to the market with your products. You're facing some big guys. There's some very large competitors, and I'm just curious how you have carved out your niche and how you're growing your business. Are you able to pass, you're using a lot of metal, different alloys, can you pass through those costs? Are they priced off the Medicare, the Medicare billing code? How are they priced? Can you pass through those type of costs? I would, obviously you have to understand the changing healthcare environment. What does that mean? And what I just said before, is it Medicare? Who's paying you? Who is your payer is a big part. There's uncertainties on legal litigation, what's out there, your products, how are you, now, is there anything out there in the industry that's a time bomb waiting to go off? And then, finally, I'm not sure, because I'm not an expert on this, but does the Obamacare, tax on medical equipment makers hit you for 3.5%, which I don't know if that was in the numbers, but I'm not sure. So that's something we have to figure out. But very nice business. Would love to be a partner of yours. Again, we're flexible. If you want to own less or more, we can work with you, but would love to have a chance to be your partner.
Thanks, Tom. There's Tom's offer. Just to clarify one thing before I let Chip start, when we put this offering memorandum out there, we asked them to bid whether they wanted a minority or a majority. So it was their choice as to what they put out here for us to put up. No negotiations happened in terms of trying to get them to do one versus the other. So with that, Chip, we saved the best for last.
Thanks, Tom. Thank you all for being here. It's really a pleasure to be here. Appreciate the invitation, and also appreciate the opportunity to go last. This is what we call in the business a last look. Unfortunately, I submitted a written offer to the contrary, so I got to be held to task here. So.
If he deviates, I put it up on the board.
I'll dive right into the actual offer itself. From a valuation perspective, we included a range of enterprise value. I think we're the only group that did that. Our range was 41 million to 45 million, so roughly 6.5 to 7 times 2014 estimated EBITDA. That was not intended to be evasive. Sight unseen, without actually meeting the people, hearing the story firsthand, being able to ask some questions, we would typically put in a range of value, just provided the SIM and the SIM only. Then we would submit a formal letter of intent after meeting the people and present our offer with a specific number with a lot of conviction behind that offer that we can deliver ultimately on that value. Our offer is for 100% of the membership units in cash. We would strongly prefer a meaningful reinvestment by Jim Bauer. We had 20% in our offer. And just for clarification's sake, that 20% equates to Jim's ownership stake in the company post-closing. So if there was 10 million of equity required, that's not the right number, but just for easy math, he would invest 2 million of his aggregate proceeds into NewCo. For us, meaningful could be anything from 15% to 40%. We would welcome an investment by him along that spectrum. And we would also provide a loan program to the executives who are not currently owners, similar to some of the others that have described that. It's important to note that those loans are recourse, but we would set the recourse level and the parameters of the loan at the lowest possible rate in order to qualify from a tax perspective, which is advantageous for those management team members. All this investment by Jim and the senior team would be pari passu with May Rivers investment, so that would be on the same economic terms, the same qualitative terms, and their investment would carry standard minority rights. From a capital structure perspective, we see total leverage also in the 3.5 to 4 times range. Would likely include 2.5 to 3 times senior debt and the rest in mezzanine or subordinated debt. I agree that this is a business that could command significantly more leverage. We typically don't want to over-lever a high-growth company like this. The last thing we want to do is for management to be making decisions based upon a capital structure. We don't want to constrain them at all in pursuing some of the growth initiatives in front of the company. In conjunction or soon after closing, we would implement an incentive equity program that would allow certain management team members to earn a total of a 12.5% ownership stake in NewCo. This would come in the form of profits interests, which are the equivalent of options in an LLC structure. I also failed to mention, we believe any rollover that Jim makes into NewCo can be structured on a tax-deferred basis so that he would not pay tax on whatever he invested in NewCo, that specific dollar amount. That requires some funky structuring, but we've done that before, and it's passed the test. The profits interest to the senior team would vest over a 4-year period. We would work with Jim to determine the appropriate allocation of this pool, which we typically see to go to the top 3 to 7 executives within the company. From the perspective of other major terms, we would want to see net working capital levels in the company that are consistent with recent history. In our offer, that was the last 12 months average. We would want to see the company meet or exceed or be on track to meet or exceed its 2014 projection. The specific terms with respect to escrow, indemnity, those are heavily negotiated points. For starters, we would contemplate an escrow holdback of 10%. We would see that rolling off within a 12 to 15-month period following closing. An indemnity cap of 25% with certain exclusions. As Tom said, that typically includes fundamental reps, which are typically authority, the power to transact, ownership stake, et cetera. Tax, environmental is often excluded from that as well. We have a 1% tipping basket with a $10,000 deductible, so it would go back to $1 once that threshold is achieved. From a diligence perspective, we would focus on standard third-party due diligence that's not really germane to this business. We typically undertake a quality of earnings, the environmental study. We believe the voice of the customer, the voice of the market, due diligence that we do is probably the most interesting and compelling and can often serve as a blueprint for the growth strategy of the company going forward. So that would be an important aspect of our due diligence. Standard insurance and benefits and legal due diligence, which is pretty typical of what any of us would do. In addition, we would focus on some company-specific areas. Given the business operates in a highly regulated environment, we would focus additional effort on the company's manufacturing and quality systems, product warranty and any specific incidents, regulatory compliancy overall, the R&D pipeline as well as product diversification, and finally reimbursement exposure. From a timing perspective, we also believe we can close within 60 days following the signing of a letter of intent. In terms of the company, we agree there's a lot to like about this business. At a high level, the situation sets up very well for a recapitalization and a true partnership opportunity with Jim Bauer and the management team. Jim's intentions and rationale seem sound. He's the right age. We believe we could help generate very significant second bite at the apple for Jim. Eric Smith looks like an appropriate next leader for the business, and we certainly applaud the fact that Jim is taking care to develop an obvious succession plan that's atypical of companies of this size. And the rest of the team looks very strong, including Dave Heiser. Obviously, the company's had strong financial performance, double-digit growth profile, increasing margins, and above-market margins relative to its peer group and what we've seen in similar companies. The business is obviously set to benefit, very strongly from the aging baby boomer demographic. And we also think that the company is poised and at an inflection point to be a $100 million business within the next few years, and that would be our objective, to drive that growth, both through acquisition as well as new product introductions and supporting general organic expansion within the business. They've demonstrated a lot of foresight in developing the company over the past few years, again, atypical of an entrepreneur-owned business. They've invested in human capital and have brought on a professional and scalable team that we think is capable of running a much larger operation. They've got significant infrastructure and systems established and a solid market presence in its core foot category. And we like situations whereby de-risking the owner's profile by monetizing at least part of his or her ownership stake can significantly enhance the growth rate of the business. And that's certainly the case here. We also like the customer diversity, the fact that it's local and in a good environment in Waukesha, as well as the bonus plan incentive system that they've established, which also is unique relative to other businesses of a similar size that we've seen. Lastly, we believe the company would be appealing to strategic and financial buyers down the road. We always consider exit options prior to making an investment, and it appears that you could go a lot of different routes upon exit, and we would consult management and really have them a part of that decision-making process. On the negative side, obviously the company carries a lot of technology risk as well as regulatory risk. We would need to better understand this dynamic in order to develop additional conviction around the business. The business is ISO 9001 certified, which is a little curious, and there wasn't mention of any good manufacturing processes or FDA compliancy. Typically, we see medical businesses with a 1345 certification, which is the medical equivalent, and we would certainly hope that that was the case here. We would also need to understand how this company is impacted by reimbursement rates, the implementation of ACA, as well as how it behaved through the 2009 downturn. To the extent that this is elective surgery and not subject to high reimbursement rates or insurance, we've seen that a lot of elective surgeries or medical procedures tend to really decrease in a soft economy. So we want to understand that better. From a May River perspective, anytime we seriously pursue a business, we want to answer the question of why would we be a good partner for that company, and why would this constitute a strong May River deal? And in the company, we believe that there's a significant amount of precision manufacturing that exists. That's really at our core in terms of our focus in the industrial growth sector. and we've had meaningful experience within medtech manufacturing as well. Secondly, we have a local operating partner relationship, this is really the case, an ex-GE medical executive to leverage. She ran $1 billion P&L, and we think that she could positively impact this company at a board level. She wouldn't look to run the business, but could certainly help us navigate the technology and regulatory risk as well. That's it.
Fantastic. The panel's done a fabulous job. I'd like to give them a nice round of applause for everything they've done. They worked really hard.